Episode 36 of the Kansas City Commercial Real Estate Market Pulse coming back at you here live from the great state of Missouri and Kansas. So everyone who knows, we are on State Line Road, basically. So Missouri, Kansas, but Kansas City, MSA, joined by what I'm trying to rope into as my co-host for this show, Mitch Case. Mitch.
Hey, Logan. Thanks for having me, man.
How are you today?
I'm feeling it today. Got a little walk/bike to school day in with the kiddos this morning, crossing Warnell Road in Gregory. So I got my Frogger on and ready to dive into some real estate.
Awesome. Yeah. Well, that's a great way to start the day, 100%. And, you know, I just want to have a quick note for everyone. If you have questions, this is a collaborative show, so make sure to drop a comment in. We are live on LinkedIn. We are live on YouTube, and we go out to all of the podcast channels. So if you show up live and you engage with us, we will take your questions and we will answer them live here on the show. So monitoring that here as well. So very excited. More Milo says, great initiative. Thanks for sharing knowledge like this. 100%, man. Thank you for always showing up and being active with us. We really appreciate that.
Yeah.
But today, we're going to look at how investors can unlock trapped equity to improve their returns and build generational wealth through the 1031 exchange mechanism, right? So we're going to use a real case study of a California investor with $1 million of equity and about a 5% return on that. And then we're going to show what happens when you put that same $1 million into Kansas City commercial real estate and multifamily. This is not theory. We are doing this every single day. And I'm going to show you how Mitch and I are coaching our clients through these decisions. So, and it's just anecdotally for everyone listening in, the amount of people that have started to reach out about selling properties in highly appreciated markets and coming into Kansas City has exponentially increased over the last 2 to 3 weeks. So I can't give you an exact figure, but 17 to 19 people have reached out to Mitch or myself. And so we thought this to be a very timely episode so that you can do an analysis, or you can reach out and we can help you do an analysis. Should you hold? Should you sell? Should you refinance, right? And we're not going to tell you just to sell and do a 1031 exchange. That's not what we're here to do. We're here to help you work through that decision, okay? And Mitch is going to be able to give some really good examples, as he just did this last night with a client who was on LinkedIn checking out one of our posts and commented and shout out. I won't name you by name because people can go back and find you and say, hey, you know, what'd you think of Mitch's performance? But at the end of the day, I know Mitch did a fantastic job. We can run these analysis in less than 30 minutes. We have to have a few items from you, but we can put this together really exponentially fast for you. So that's first step, is if you are interested in looking at how to unlock your equity, that's what we're talking about today. Step number 2 is evaluating the current landscape and doing a full market analysis of Kansas City in regards to multifamily, industrial, retail, and office. So we're going to start with the multifamily side. We'll be coming with you live in the next 2 weeks with a comprehensive investment overview. How many deals are listed? What's the average price per door? What are the rents? What's the occupancy? What's the vintage? How big are those properties? Where are they located? Missouri or Kansas? All of those things. So you can start to frame your next decision and to see if you want to get into multifamily or maybe something that's a little bit more easier to manage on the commercial real estate side. Okay, so that's what we're focused on today. So our full agenda looks just like this, right? 1031 exchange overview, understanding what return on equity is. I think it's very misinformed and confused out there with other return on investment metrics. I'm going to cover the Kansas City market. We're going to go through our case study analysis. We're going to give you a comparison of the options that we laid out for this client. We have to talk about risk, right? We always have to think about the risk that you have in regards to these decisions. So first and foremost, Mitch, you're an owner of multifamily real estate, man. Give us an overview of what a 1031 exchange actually is. So for people who are like, what the heck are these guys talking about, right? Like this word is called, 1031 exchange, all of these different components. But break down what a 1031 exchange actually does and is for our clients.
Yeah, so it's not just another form on your tax return at the end of the year. It's actually a strategy that you can use to truly defer the capital gains that you may have from increased equity or capital improvements that you've done to your property to force that appreciation. So it truly is a way to utilize the equity that you have earned, put in place, worked hard, or invested in to be able to step that into another property without being hit on the capital gains that would come from what you would typically do when you make a sale from a real estate purchase. You're going to get hit typically on those, and you can lose. I mean, correct me if I'm wrong, Logan, probably anywhere from 30% of the profit that you could potentially keep. And when you start talking large numbers in the millions of dollars, that loss, that capital gains tax that you would have to pay to Uncle Sam, is missed opportunity that could go towards another property. So this is really just a strategy to take your investment that's maybe a little bit smaller and 1031 exchange it into another property and continue to defer those taxes for future properties.
Absolutely. IRS code 1031. This is not something that Mitch, myself, any other commercial real estate practitioner has come up with. Been around for a long time. It helps you and lets you defer taxes, keep compounding your capital and move it into bigger assets without taking a haircut. So in simple language, instead of paying the IRS, you can put your money back to work, right? The secret's not just in avoiding tax. It's about multiplying your buying power, moving from one door to 10 doors, from a house to a retail shopping center, right? From a duplex to a 35,000 square foot industrial building. If you are interested, we have one of those available, just came through today. So definitely reach out to us on that front, okay? Now we have to unpack what return on equity actually is. And I think this is where most investors miss the mark, right? This is what your actual cash invested earns today, not 5 years ago, right? So if you are in a property and you're in an area where you have highly appreciated equity, California, other coastal markets. I've even seen it where forced appreciation has come up, right, through the value add that you've done, but your net operating income or your cash flow is not keeping up with that appreciation. Your return on equity actually goes down, right? And so that's something you have to keep on track. So like 5 years ago, your return on equity might have been really great, but now, just because it was great 5 years ago doesn't mean that it's great now, right? So now, when you do research on return on equity, you will see that ROE is used in the business terms quite a bit. And you're going to see that net income divided by shareholders' equity. In regards to commercial real estate and real estate, we're looking at your annual cash flow divided by your total equity invested, okay? And it's a critical metric that measures that annual cash flow on the actual equity invested in a property. So it's revealing how efficiently a property generates profit relative to the capital directly contributed by the investor, which offers a clear picture of the investment performance and efficiency beyond finance portions, all right? So just keep that in mind. I don't think a lot of people are doing an analysis of ROE. And Mitch, hey, I mean, we've started to work on a couple of these analysis. What stood out to you in regards to return on equity? And have you been evaluating your own portfolio in regards to your return on equity?
Yeah, absolutely. We've been looking at our own portfolio from there. I think the thing that stood out to me the most, and you kind of to hit on it, but as you hold your properties and tenants are paying down the mortgage, your equity is slowly increasing in that property. And as you mentioned, oftentimes our NOI, our net operating income, is not increasing with the pace at which things are being paid down, or that the property is appreciating just due to market conditions. And all of a sudden, what was a really strong return on equity is now being decreased. And it's not necessarily a bad thing. It's just a strategy or a risk tolerance that you'd be willing to take on. But the more equity you gain in your property and your NOI is not increasing with that, it's actually less of a performing when you look at the return on equity. And so that was really eye-opening to me as we kind of dove into this a little bit more, that it's not a bad thing that your tenants are doing that and you're increasing your equity. It's just, is that the strategy that you truly want? And this is really why we're trying to evaluate, how is the effectiveness or the efficiency of the equity that we have in this property? Is it being best utilized here, or do we need to look at other opportunities?
Absolutely. And we can help you walk through all these calculations. We're going to give you an example today, a real life case study. But at the same time, most of the properties and folks that are reaching out to us, we're seeing a return on equity currently about 3 to 5%. And that is not inflation adjusted, right? So that is just their return on equity currently. Okay. So that is something that we are trying to work with them on to say, hey, how do we get this into double digits? Do you want to take on that risk to be able to do that? We are going to talk about risk today. I have to tie in James Clear here, because Atomic Habits, one of my favorite books of all time. Think about your improvements 1% at a time. It compounds, right? So small tweaks in your return on equity dramatically change your wealth trajectory. That's the biggest component to be thinking about here, right? And I know that folks are going to say, hey, well, it's hard to find a price per door and a cap rate that makes sense, which is why we tend to work on value add, forced appreciation type of opportunities, right? So you have to keep that in mind as well. Now, what we want to kind of go into next is a little bit, and if you follow myself on LinkedIn, you know that I post about Kansas City at least once, if not twice a week. But I'm going to give you a high-level overview, and I'm going to try not to sound too much like I'm running for mayor here, but I do want to just give a highlight. If you're not familiar with Kansas City, Missouri, and Kansas City, the MSA, it's where affordability and growth meet. We have strong employers, steady in-migration, about 1%, so 25,000 people per year, and that yields that can really beat the coast on in-place, right? So you contrast $1 million in California maybe gets you a house. $1 million is the down payment on a $4 million deal here in Kansas City, right? Which, can get you close to 15 to 30 units, depending on where you're at, right? And this is why institutional capital and coastal investors are pouring back into secondary markets like Kansas City. We just posted, one of my good buddies just posted a $113 million sale of a build-to-rent community, 5 different communities, 500 plus units, all around Kansas City to an institutional player. So that capital is coming back into the city. And just some of these numbers that I want to share with you guys. There's over $50 million, which is the value of data centers over the next 20 years. Okay. And there is a lot of talk around data centers. Why? Well, we have land, we have access to power, and we have areas like DeSoto, Kansas, where Panasonic is already going into. So you start to see these kind of tech things happening in that area, right? And I apologize. This is $50 billion of data centers. I apologize. Not 50 million. $50 billion of data centers over the next 20 years. Okay. Google just dropped $10 billion of investment fueling tech and logistics. Panasonic, $4 billion into the EV plant in DeSoto, Kansas. And there is all kinds of value in regards to the infrastructure projects that are committed for the next decade. Okay. So, there's a lot of money flowing into Kansas City, and there are a lot of areas that you need to keep your eyes on, which we can absolutely support you in regards to thinking about Johnson County versus Jackson County versus Eastern Jackson County versus north of the river, south of the river, west of the state line, east of the state line. There's demand drivers for each one of those locations. We can help you navigate that, because as we went through our Kansas City MSA multifamily market analysis, you're going to get a list of 65 properties, about $195 million worth of real estate, over 2,000 units listed, and they're going to be all on a map, and you're not going to have anywhere or any know-how on where to start looking, right? So we can help you pinpoint that, right? So that's something that we're going to be able to help you with on a regular basis. All right, now let's move into our case study, okay? So, Mitch, I'm going to have you break us down, the case study here in just 1 second, but I'm going to give the real life story, okay? The investor has $1 million in equity in the California house. It looks great on paper until we ran the return on equity, right? And so, we're going to be able to break this down here in a second, but we showed them how 1031ing into Kansas City multifamily not only diversify their income, but also reset their returns into double digits. And we gave multiple scenarios, but here's the starting point. Mitch, walk us through the actual, current property in California.
Yeah. So obviously some of the information we're going to need is the equity that you would have in your property, which is in this scenario, we've got about $1 million in equity. We really want to evaluate what that property is currently doing. So we're going to get an idea of rent, and we're going to look at expenses. And at the end of it, you're going to be able to come up with what your take home is. And what we're going to call that is just a net cash flow. So after all expenses are paid, we'll toss in the mortgage on that, which, net operating income is not going to include your mortgage rate. But in this scenario, when we want net cash flow, we're going to toss that in there. So you're going to see here broken down, your gross rents are about $77.50 per month, minus your property management fees, minus mortgage and all other expenses. This particular investor is taking home roughly $50,000 a year in net cash flow. And from the surface, that looks amazing. And if you're looking at it from just a cash flow perspective, and that's what you want, then this is a well-performing property. But as we talked about, some of the things that when we start looking at the return on equity, you start looking at those numbers and compared to what are we taking home over what equity do we have, you start to see that, a 5 to 6% return on equity, it's just not all that great of a return on the money that you have that is locked up in this property. And so this is really what we're kind of talking about, is looking at two different metrics, because even myself and our properties, you get so caught up on, well, we want to have X number of dollars per month in cash flow. But then you start missing out on the opportunities that cash that's saved in your property, which is not liquid at the moment, can that be working harder for you in developing an even better cash return? So This is a lot of those conversations that we're having. Did I miss anything, Logan?
I think the biggest thing to point out, one of the biggest things, is the mortgage here makes it look great, right? This
right. Yeah, that's a great rate.
This investor has a 2.25% interest rate, 30-year fixed, right? So the mortgage makes it look great, but the equity is lazy. It's trapped in this deal, okay? So even with the scenario that we're giving here, right? Like, it's a 2.25% current mortgage rate. Yes, it cash flows around $49,000 a year with that mortgage rate. You cannot get that mortgage anymore. That rate does not exist anywhere.
Yep.
So if you were just to go and double that, right? You double that. That's going to be $6,000 a month, and now your cash flow is at $1,700 a month. Okay, and so just keep that in mind, that we are showcasing a scenario here, almost with best in class mortgage rate that was put on that loan 4 or 5 years ago. So I think that's really important for us to think about. Yeah. So just moving on to kind of the key insight before we get into all of the different options, right? But on paper, like the California rental looks like a cash flow machine because of that ultra low mortgage rate. But what's misleading is that their return on equity is low. It's 5%. So we're going to showcase this in a moment, but by 1031 into a multifamily deal with 25% down, you could invest in a $4 million property at a 7% cap rate, generating around $280,000 of net operating income. After debt service, so you have a loan at $3 million, and at 7%, the cash flow is approximately $25,000, right? Which results in a cash-on-cash return of 2.5%. While that initial cash flow may be lower, this move does allow them, and don't get me wrong, we're not saying that this is exactly what you should do, but this move does allow them to unlock significant equity, diversify that risk, and gain some more tax shelter benefits, which would then position them for long-term appreciation tied to that growth, right? So just going through the calculation for everyone, here it is, right? You got your net cash flow of $41.38 per month, and Mitch made this very good clarification point. We do bring out the debt service and interest, as well as the insurance, because we want net cash flow, right? So that's our annual cash flow divided by our equity is 4.96%. So what I'm going to speak about next is all the different options that you can utilize to unlock your equity without selling. This is always something that we advise folks to go through and think about, because if you can, you're sitting on a 2.25% interest rate, If you can keep that loan in place, still cash flow that house and unlock that equity, that's a win-win-win scenario, right? Now, not very many people are in that scenario, in that situation. So you have to keep that in mind. But the 4 different options that we have here are cash out refinance, which, for a lot of people right now might not make sense. You can also do a home equity line of credit. We work with a decent amount of investors who do utilize HELOCs. There's also home equity loans, and you can actually go find private partnerships to syndicate the equity inside of your own home. Now, they will start to get ownership in that other property, right? And that's a little less common in the marketplace, but there's 4 options to evaluate to unlock your equity without actually selling. So we walk everyone through all 4 of those options to try to see, hey, can we keep this property without doing a 1031 exchange? So we're truly trying to advise on that scenario, right? And so some strategic considerations to kind of think about, right? I mean, number one, even with the HELOC and the second lien, the original $1 million of equity is still lazy, right? They're still going to be layering on more debt. And tapping equity does tie into the property to additional repayment obligations. So if your rents stall out, or one of those tenants moves out, or they stop paying and you can't get them out of the house, your cash flow could shrink even further, right? Now, there is opportunity cost, right? A 1031 exchange cleanly resets that equity into higher yielding commercial real estate. And we're going to talk about the risk specifically for 1031 exchange here in a second, but you will not have necessarily more debt on top of that house, right? So those are some strategic considerations to think about. And when we're working with our clients, each one of these points is about a 10 to 15 minute conversation. I know we're just glossing over these right now, but we have a lot of content to kind of get through. And I want to get to this side-by-side scenario so you can really get an idea of what this might look like. But these are some strategic considerations to kind of keep in mind. All right. Okay. So Mitch, walk us through kind of the 2 different options, right? Option A is, keep the house, tap a HELOC and reinvest. Option B, sell 1031 in a multifamily. And yeah, let's just go through both of these. What are some of the assumptions that we're making here on these side-by-side comparisons?
Yeah. So, I mean, with the HELOC in general, and this kind of works from the numbers that I was working with a client last night, was they're roughly only able to unlock about 50% of the equity that is in their home. And then you're going to be looking at anywhere from 7, 8 to 9% interest on that money. So you're going to layer on that equity or that payment inside of there. So this first option that we're kind of looking at is let's keep the house. Let's keep that 2.25% interest rate because that is unheard of. Let's jump into a HELOC at that rate that we just kind of talked about, and then layer on that we can purchase another property with that HELOC. So a lot of the same numbers that we've been going through for scenario 1 here. We've got the existing house, we've got gross rents, property management fees, debt afterwards, mortgage payments, and really bringing out that existing cash flow to about the $50,000 a year mark. So now let's add that HELOC to that scenario. So about 50% of that equity at 8%, you're going to be looking at interest payment of about $40,000 a year. So net cash flow with the home and the HELOC, you're going to be looking at about $9,600 per year. Now, that just unlocks the equity. So now what are we going to do with that by layering in another purchase of a new asset? And what that's going to look like, if you're able to redeploy that $500,000 with 25% down, you're going to be looking at about a $2 million. In this scenario, we'll look at a multifamily property at a 7% cap rate. Current interest rates for anything along those lines are going to be right around that 6.5 mark, 25-year amortization, which is pretty standard for right now. So if we layer on that $2 million purchase value from $500,000 down at a 7% cap rate, you're looking at investing the $500,000 with that $1.5 million loan amount, interest rates, amortization. Your monthly mortgage payment is going to come down to about $10,000 a month, or a little over $121,000 per year for an annual mortgage payment. So if we take in the net cash flow from that new multifamily property, that NOI that we've determined being around $140,000, and we subtract out the annual mortgage payments, you're looking at netting about $18,000 per year. So with that combined performance from the existing property that you're carrying and utilizing the HELOC to unlock about 50% of that equity, and now adding in the new multifamily purchase, that combined net cash flow at about $28,000 a year, with the equity that you invested, around $1 million, your total return on equity is going to be that net cash flow divided by that equity, which is only at about 2.84. So you are losing a lot of the power of your money that you have by leaving an additional 50% of equity in that property. And in this scenario, by keeping that house and using the HELOC to invest, your return on equity is actually decreasing versus increasing in this scenario. And so this is where it becomes just a really, really low return on the equity that you have, and you're not getting as much as you could out of it.
Yeah. I mean, you're hearing commercial real estate advisors over here tell you that this strategy that a lot of people talk about on a regular basis is not going to work, right? And you may say, hey, there's no operating expenses in that scenario too. There is, because we are taking the net operating income. So the net operating income will include those operating expenses minus the debt service, okay? We have fine-tooth combed these figures, okay? Sure, they could be off 5 to 10%, but generally speaking, trying to tap into a HELOC, go and buying a $2 million property at a 7% cap rate in today's interest and financing environment, and keeping the single-family home yields a 2.84% return on equity, right? Which this strategy yields a very low return on that client's $1 million. So we would advise not to do that, right? Unless some things in the market will change. So that's option A. If we move over to option B, walk us through actually selling and doing a 1031 exchange, Mitch, on what somebody might be able to accomplish.
Well, I'm going to hand that back to you real quick, Logan, because I just got notified that I don't have my computer plugged in. So I'm going to hand that one back to you real quick while I get this thing plugged in.
Absolutely. Okay, so if you're going to do a 1031 exchange, we have $1 million of equity available. We likely can go get a $4 million property. At a 7% cap rate, we're going to be generating around $280,000 a year. Your debt service, 6.5% loan at 25 years, is around $201,000. So your cash flow, your net cash flow, is going to be right around $78,000. So we have now increased from our 4.96% return on equity up to a 7.86% return on equity on the multifamily side. But here is the real power, right? Instead of average deals, we're trying to target value add deals like the Kansas City 10 unit that we just recently sourced, right? And the 18 units that we just recently sourced, right? So equity deployed into that, right? If we can get cash flow of $118,000 a year, right, updated with 25-year amortization, we're going to be able to get all the way up to 11.8%, right? And so that's going to allow you to really unlock this equity and go from 4.96%, have a 100% increase, 100% plus increase, all the way up to 11.8%, doing a 1031 exchange via a value add scenario, right? So let's walk through that, right? So here's another option for somebody, okay? So we know that Freddie Mac and Fannie Mae loans are in the 5% range right now. So if we were able to go source a more stabilized property and you can qualify for a Freddie Mac loan, we're able to get around 5.5% down, or 5.5% interest at 25% down, amortized over 30 years, right? At a 7% cap rate, we're going to be able to identify a property that's stabilized of a 7.56% return on equity. So this analysis is highlighting the critical importance of the acquisition cap rate, right? It doesn't make sense to go buy a 5% cap rate unless there's value add. 6%, no value add, still doesn't make sense, right? If we can get to a 7% cap rate, or we can build to a 7% plus cap rate over the next 2 years, now we're getting where we can get anywhere between 8% and 10% return on equity, right? And so there are different levers out there depending on what your risk tolerance is, what you can qualify for in regards to the financing structure. But if you can go get some non-recourse loan with a property that's a little bit larger and it's stabilized and it qualifies for this type of loan, that can really help juice some of your returns going forward. Additionally, what we see is a lot of investors actually saying, hey, I don't want to be in multifamily anymore. I want something that has less headaches and more of a coupon. Okay, well, let's say we can go get kind of a retail, quasi-office, retail, industrial deal somewhere around 8% cap rate, right? And so if you can do that and you are comfortable moving from a single-family home to a commercial real estate investment, which you would have an asset manager and property manager dealing with the businesses, maybe you go to four businesses that have a weighted average lease term of 3 to 5 years, so they're not leaving for the next 3 to 5 years, you might be able to actually unlock a return on equity going straight into an 8% cap rate deal out of a 6.5% loan for 25 years of 11.86%. So we're seeing a lot of investors say, hey, if you can source me something, that's backed by a really good business or multiple businesses in a good location, and it has a longer weighted average lease term of 3 to 5 years, I don't have to really mess with it for quite some time. That could be really attractive, right? And so people are, in the investor side, they're thinking about, man, maybe I don't have to do a value add deal. Maybe I can go in, get a 7.5, 8% cap rate commercial deal and unlock some of this equity. So we've helped a lot of investors buy retail properties, by office properties, and by industrial properties that are a little easier to manage in some regards, but also a very good option for people to evaluate, right? So, Mitch, we've talked. Oh, go ahead.
Well, I was gonna add to that just a lot of conversations that I've had from what would be considered an out of town investor or a coastal investor, especially these individuals that have maybe owned this property for 10 years, have been managing it themselves, and now they're trying to find certain cap rates that seem like they don't exist, but they do here in the Midwest, specifically in Kansas City. But their concern is always, well, my property now it's just down the street. I can kind of keep an eye on it. I can feel safe about it. I don't have to do too much, and I get to manage it myself. And this was one of the conversations that we had on that, was being able to take that, if that is a fear of an individual, and get this into more of a stabilized asset that doesn't take as much management and will be a lot easier to sleep at night when this is, thousands of miles away from where you personally live. And so that was a huge fear that we were kind of able to unlock with some of these individuals, that you don't necessarily have to have something that's hairy and dirty to get a reasonable return. It's just what risk tolerance do you have, and how can we mitigate as much of that as we can?
Absolutely. That's a really good point. I mean, I've got a guy in a city, I won't say, I'll just say Columbia, Missouri. And he's like, hey, I'd like to sell these multifamily properties and get into a commercial deal, right? That's exact words that he spoke to me last week. So we can definitely help you evaluate those. Some of those things that, you need to be thinking about, though, from a risk standpoint, right, is bigger deals mean more tenants sometimes if you're doing a larger multifamily deal. It means more management on the multifamily side, more market exposure, right? So with risk comes scale, right? But also you have your depreciation and your growth. You're in control of the manager, not just waiting on the California appreciation, but you have to do your homework on location, management, and financing. There's so many market dynamics and location risks to think about. There's a management complexity to think about. You have to leverage. You have to use leverage in the right way. So it might be more debt than you've ever had in your life, right? And then we have to be thinking about our liquidity and our exit strategy as well for each one of these assets. These are all things that we can help you go through. After doing over 150 commercial real estate and multifamily transactions and over $450 million of deal worth of deals, we can help you think through all of these options. But we do want to make sure that, hey, there is risk in doing a 1031 exchange, right? If you don't want to do anything that we're speaking about, we have options like a DST or a 721 exchange that we can also talk to you about. You want to be completely passive, and you want to go from actively managing and owning property to passively owning property. We do have those options and individuals that are working with investors to do that. Now, your return and your yield may be less, and your tax implications may be different, but there are options for you to do that. So if you have inherited a property, you have no interest in continuing to trade up and do the real estate game, reach out to us still. We can still help you with that for sure in regards to that. So, Mitch, we've gone through a lot today, man. But just the bottom line, man, let's wrap this thing up. We're 4 minutes over already of our 30 minutes, but that's okay. Wrap us up in regards to what we have found out for this specific case study.
Yeah, this specific one, even if you have really low debt on a property, or even if you own it free and clear, with today's rates, utilizing the HELOC strategy to unlock that equity just isn't going, it's going to keep your money lazy. And so really the best opportunity to increase your return on equity is going to be through the 1031 exchange. And dependent on your risk tolerance, there's opportunities to play it more safe and just have something that's more stable, get good rates, a non-recourse loan through a Freddie Mac option. Or you can take more of a active approach and turn that low equity return on equity from a 3 to 5% up to even double digits, specifically with opportunities here in the Kansas City area. So being able to unlock all of that equity inside your property and deploy it into another asset class is truly going to be the way to best unlock the equity that you have, if that is truly what you're looking to improve.
Yeah. I think the other thing on the risk side of things, guys, we will see 1031 investors actually come in, and instead of doing a 75% loan to value, they want less risk. So they'll actually put in 50, 55, 60% of the equity and still get 25 to 30% of debt, so that debt service coverage ratio is still very high. Yes, that can impact some of your returns, right? Because the property is not going to be as large, but you fall down in regards to the risk spectrum. So we'll see a lot of 1031 investors put less debt on their replacement properties to reduce that risk, but still continue to gain net worth, to get more cash flow, and to unlock that equity that's in a house in California or a highly appreciated market that's just sitting there. And if somebody leaves, they have no cash flow at all. So don't think that you have to come in and put 75, 65, 75% debt on a property. You can come in, and oftentimes, if you're going to put that much more cash in, you're going to get better terms from a bank anyways.
Yeah.
And not only that, we can coach the sellers to say, hey, this person's not going after a highly leveraged loan, right? It's not going to be a risky deal. So they're going to be able to get the financing, and they have the equity in the house. Not only are you reducing your risk on that profile of that next property, you are also, increasing your opportunity to have a higher debt service coverage ratio. And so all of those things come into play when we're thinking about doing these 1031 exchanges. Okay, so all things that you can reach out to us about, connect with our team, connect with Mitch, myself, anyone else on the Midwest Commercial Real Estate Advisors team. Here's our website, www.mwcreadvisors.com. Here's my phone number. Here's Mitch's phone number and our email addresses. You know what? These are the wrong email addresses. I do not know why I cannot get our email addresses. If you can't find our email address, then that's your own fault. But reach out to us on LinkedIn. It is Logan at mwcreadvisors.com and Mitch at mwcreadvisors.com. If you're watching this, that is incorrect. I always type that incorrectly. It's like this buyer that I had the other day for a property. I kept calling him John Witten, and his name was Rodney. And I'm like, where is that coming from? So anyways, you can contact us at mwcreadvisors.com. You can find us on LinkedIn. Over 3 people have reached out to me in my DMs on LinkedIn today, and I have already talked to them on phone calls, and we are already working on trying to look at advising. So very excited about this opportunity for all of these individuals to unlock their equity utilizing the 1031 exchanges. If you're not doing a 1031 exchange, but you're still looking for your first investment property, that's fine too. Reach out to us. We work with a lot of people that aren't doing 1031 exchanges as well, that are looking for investment properties. Just a little bit of a flavor. We have office building, a 48,000 square foot office building. We have land and with development potential for flex industrial, for multifamily, and for single family homes. We have multifamily properties. We have an 18 unit. We've got multiple multifamily properties that you can reach out to us about, and we can talk through as well. And we're working on a few industrial properties right now, if that is of interest to you as well. So all of the things that you have seen in this presentation today, we have actual deals that we can fill in, and you can start to analyze those. If you're simply interested in about Kansas City, and want to learn more about the multifamily market or the industrial market, reach out to us as well. We're going to be coming to you guys live on a weekly basis, talking about our comprehensive market snapshot on the multifamily side first, but we have that available. We can send you the PDF. Just reach out to us, reach out to Mitch or myself, mwcreadvisors.com. You can always find us, and we'll send any of this market intel that we are seeing with boots on the ground on a regular basis. So thank you guys for joining us today on kind of an impromptu episode of the Midwest Commercial Real Estate Advisors Market Pulse, the Kansas City Commercial Real Estate Market Pulse, coming to you live every single week. We got another great guest next week. Mitch and I probably will come in and do another episode. do give us a follow on all the Spotify's and iTunes platforms. Leave us a review. If you're getting value out of this, definitely leave us a review. And make sure to join us. Leave your comments and your questions in the comment section. We'll reach out to you. Mitch, anything that I missed?
I think I would just add that anybody that is maybe looking from an out-of-town area and interested in the Kansas City area, we do more than just property analysis and deals. We can connect you with, different teams that you might need, from property management to land advising. Absolutely. To brokers and bankers and other team members. So don't feel like you're alone or don't know where to start. We can definitely help you on all of those areas as well with trusted partners that we have.
Yeah, most definitely. Thank you guys for tuning in to another episode of the Kansas City Commercial Real Estate Market Pulse. It's Logan and Mitch signing off. We'll see you next week.
See you guys.